Wall Street just had one of its worst days in over a year. The tech-heavy Nasdaq posted its biggest one-day drop since April 2025. The S&P 500 fell sharply off its record high, and the Dow was dragged lower too. So what happened? Why did the stock market suddenly turn on the very companies that powered its rally? Today, we break down the big tech shakeout, the concentration risk hiding in plain sight, and what it means for your money. First, the trigger. The selling started after a surprisingly strong jobs report. Now, normally, a strong jobs number is good news. It means the economy is healthy. But in a market that's still dealing with stubborn inflation, it had the opposite effect. Investors read it as a signal that the Federal Reserve will keep interest rates higher for longer, and quite possibly even raise them again. Higher rates squeeze the stocks that are priced for perfect, distant future growth, and that means tech. So traders who had been betting on rate cuts were forced to reverse course fast. The Nasdaq fell more than 4% in a single session. But here's the deeper story. This sell-off wasn't really about the jobs report alone. It was about concentration. Over the past few years, a handful of mega-cap technology and AI chip companies have come to dominate the entire market. Right now, the top few names in the S&P 500 account for a record share of the index's value, somewhere around a third of it. That's a level not seen since the dot-com bubble of the early 2000s. It means when those giants wobble, they take the whole market down with them, even if the rest of the economy is doing fine. So when sentiment turned, big investment funds pulled money out of AI and microchip names that had soared for years, worried they'd become overvalued. And critics warn the run-up echoes the dot-com era, where sky-high valuations eventually collapsed. That fear is what turned a routine pullback into a market-wide stumble. Here's the part that matters for everyday investors, and it's a bit reassuring. The sell-off did not turn into a global panic. Instead, it was a rotation. Investors didn't abandon stocks entirely, they shifted into safer, defensive corners of the market. Healthcare, utilities, and consumer staples all saw money flow in as traders hunted for stability. It's the classic move when people get nervous. Cash in the riskiest winners and park it somewhere safer. At the same time, bond yields have been climbing, with the US Treasury selling 30-year debt at some of the highest borrowing costs since 2001. Rising yields are another headache for growth stocks because they make the future profits those stocks promise worth less today. It's one more reminder of how tightly the whole system is connected. So what's the takeaway? First, don't panic when headline-grabbing indexes drop, because a big chunk of those drops is often just the biggest tech names repricing. Second, understand your own concentration. If your portfolio leans heavily on tech or AI, a single sector hiccup hits you hardest. And third, this is exactly why diversification still matters. A balance of defensive sectors, bonds, and cash can smooth out the ride when the market gets spooked. Now, a quick note, this is not financial advice, just an explanation of what's moving the markets. Big tech volatility is real, but so is the long-term history of markets recovering from